basically a lot of countries are saying maybe we shouldn't have 100% of our reserves. Maybe we shouldn't have 80% of our reserves in dollars and treasuries because a handful of people in DC can just snap their fingers and seize those funds, or prevent us from accessing that whole ledger and making payments in dollars. And so there's a push by some countries to diversify their reserves. So either a couple different types of fiat currencies, or gold, for example, and then also to diversify their payment systems. So instead of being so reliant on Swift and having so many payments basically go through New York, they want to have, bridges between central banks and things like that in order to facilitate more non-dollar trade.
Over the past few months, China, Russia, and other BRICS nations' de-dollarization agenda has been widely discussed and debated in many circles. In the United States, experts are divided over whether or not de-dollarization is happening or can be allowed to happen, and if it would be beneficial to the United States economy in the long run. On the other hand, investors do not seem particularly bothered about this brewing storm yet. Between the Fed's continued interest rate hikes, the recent regional banking crisis, and other internal threats to the ailing economy, there's little time to pay attention to what is happening outside the United States. In addition, a significant number of U.S. investors believe in the indefectibility of the U.S. dollar and the country's superpower status. Many people cannot imagine a world where the United States, with all its resources and military and economic might, is not lording over the rest of the world as it wills. To investors in this category, de-dollarization is a foreign and relatively new concept being pushed by the media to cause mass hysteria. But many experts agree that the move away from the U.S. dollar has been on for about 2 decades. Since the early 2000s, the dollar's share of reserve currencies has gradually declined as foreign central banks have continued to diversify into other fiat currencies and commodities like gold. But the diversification was happening at a subtle rate, not enough to cause any concern or even be noticeable to the average investor. Last year, things took a wide turn after a barrage of financial and economic sanctions were announced against Russia for invading Ukraine. With how swiftly Russia was cut off from the SWIFT system and how quickly its assets were confiscated, many countries became more motivated to move away from the incredibly centralized system before they are forced off and their assets confiscated. In a recent interview with The Jay Martin Show, popular financial analyst and founder of the Lyn Alden investment strategy, Lyn Alden, discussed her views on the increasing de-dollarization agenda and what it all means for the United States economy. According to Alden, until late last year and early this year, central banks were working more on decreasing dollarization than actual de-dollarization. They kept fewer U.S. Treasury bills because they realized they were basically financing the U.S. government at negative real rates. At that phase, the decision to turn away from the U.S. dollar was purely about finances and returns. Now countries are more motivated to turn away from the dollar for survival. How does this all work out? Can countries facilitate trade without using the world's reserve currency? Alden provides some interesting answers in this video. Please watch the video to the end, subscribe to the channel, and turn on post notifications so you never miss any of our videos. Thanks and enjoy the video.
We don't see like rapid de-dollarization, but we kind of see like no longer increasing dollarization over the
Yeah,
past
okay.
number of years. And then,
Yeah.
This past year, you've seen a little bit more acceleration in de-dollarization. Um, and I think there's kind of two big underlying foundations for that. So number one is that ever since the global financial crisis, and a few years after that, a number of countries decided that basically treasuries are probably not going to be very attractive, and they don't want to finance the U.S. government at negative real yields. So I mean, for much of the 2010s decade, for example, T-bills were yielding less than inflation.
Yeah.
Longer duration treasuries were yielding, roughly in line with CPI. It kind of varied over time, and they were underperforming, other assets like equities and real estate and things like that. And so a lot of these governments said we don't really want to, facilitate that. China, in particular, in 2013, said it's no longer in our interest to keep accumulating treasuries. They just made to come out with a statement. And so what China was at the time in the prior decade, the biggest, net buyer of treasuries. And so what China started to do instead, for example, is they started to use their dollar surpluses, their dollar trade surpluses, instead of funneling them back into the U.S. Treasury market, they started making loans. Say that, the Belt and Road Initiative. They started doing kind of like what the IMF and World Bank do, on their own scale, where they go to countries in Africa or other countries in Asia or certain countries in Latin America or Eastern Europe, and they say, okay, we're going to provide dollar loans in order to build this, railway or this commodity development or this refinery. And so they found that to be a better use of their dollars than plowing them back into treasuries. You had other central banks, like say, the Swiss National Bank, plow it into U.S. equities um, rather than U.S. treasuries. And the other ones, just, the dollar was pretty strong, especially, starting in 2014, 2015. And so many countries were just kind of not accumulating reserves and therefore just not accumulating much treasuries in general. You also saw from the 1970s until around 2009, there was this like net reduction in central banks holding of gold. Kind of it was like the slowly declining gold stash. But starting in 2009, you had like a V-shaped recovery where central banks began reaccumulating gold on net. And so they found that, to potentially be a better reserve asset for them. So that's number one is basically the unattractiveness of treasuries that don't keep up with inflation, which is an environment we've been in. The other one is basically that the treasury and the dollar market in general is a permission to ledger. So it's a ledger that, you can be cut off from. Your assets can be unilaterally seized. And, obviously it's not done arbitrarily, but, most countries around the world have had periods of time over the past, say, 50 years where they've not been in the good graces of Washington for one way or another. The severity can obviously differ. Sometimes it's like an outright war. Other times it's just, various agreements. Maybe the Treasury doesn't want India doing business with Russia, and India says, well, we're going to do business with Russia. And so India is not in the bad graces of Washington, but it's not maybe not the best graces of Washington. So basically, a lot of countries are saying maybe we shouldn't have 100% of our reserves. Maybe we shouldn't have 80% of our reserves in dollars and treasuries because a handful of people in DC can just snap their fingers and seize those funds or prevent us from accessing that whole ledger and making payments in dollars. And so there's a push by some countries to diversify their reserves. So either a couple different types of fiat currencies or gold, for example, and then also to diversify their payment systems. So instead of being so reliant on Swift and having so many payments basically go through New York, they want to have, bridges between central banks and things like that in order to facilitate more non-dollar trade so that they can't have their payment systems shut off either. So both has protection for their savings and payments on a permission ledger. They want to have basically an assortment of other payment and savings mechanisms to choose from.
Last U.S. Treasury Secretary Janet Yellen discussed the increasing threat to the United States and the U.S. dollar's dominance on the international stage. She noted that the sanctions against Russia and other countries threaten the dollar's dominance as the world reserve currency, but it wouldn't be easy for countries to find an alternative to help them boycott the dollar. The Treasury Secretary said, "There is a risk when we use financial sanctions that are linked to the role of the dollar that over time it could undermine the hegemony of the dollar. Of course, it does create a desire on the part of China, Russia, and Iran to find an alternative, but the dollar is used as a global currency for reasons that are not easy for other countries to find an alternative with the same properties." Yellen also added that the robust U.S. capital markets and rule of law are essential in a global currency, and no other country has the basic institutional infrastructure that would enable its currency to serve the world like the dollar has been doing since the end of World War II. According to Alden, there are always ways of getting things done. Let's get back to the interview as the popular analyst describes how countries can facilitate international trade without using the US dollar and why central banks are loading up on gold.
Yeah, I think they'd have more freedom with their reserves. They also might be able to hold less reserves because, like, nobody exactly, for example, wants to hold a lot of Chinese bonds. They don't want to have like, 50% of their central bank reserves in Chinese assets. It's got capital controls. It's not super attractive. But China, for example, is the largest trading partner with most countries in the world now. Over the past 20 years, they've surpassed the US for most countries as their biggest trading partner. And so with let's say China and Brazil trade. Brazil sends a lot of commodities to China, and China sends a lot of electronics and other products to Brazil. And so one thing they can do is just basically, like one of them gets a temporary surplus and it gets plowed back into the goods of the other one. You have that more circular payment system that doesn't really need to use the dollar. And they both might hold some degree of each other's reserves, with excess reserves maybe going over into gold or something like that. That's generally kind of a trend we're seeing. And so, while I don't think you'll see massive reserves, in these other types of countries, I think we're slowly seeing a diversification of reserves. I mean, Chinese holdings of Chinese, assets among global central banks over the past, say, 5 years went from like virtually zero up to, you start to see countries doing like, 3, 4, 5% of their reserves in that. So it's a marginal change, which then we also combine with, gold increases. You have a little bit less focus on American and European assets as reserves, and a little bit more focus on bricks, gold, that kind of thing. People in the past, when they talk about prior global reserve currencies, they act as though like there's just kind of like, a different reserve currency over time, which is partially true, but all those past ones were basically just proxies for gold. I mean,
Right.
central banks would hold gold. Sometimes they'd accept each other's, payment ledgers and bonds and things like that as like gold proxies that are maybe more convenient and pay some interest. But essentially gold was at the center of the system. And since the, 1970s, the Treasury kind of replaced gold as a key part of the system, which is that, instead of holding a gold proxy, all these central banks around the world will hold dollars and treasuries as usually their primary asset. And that system kind of reached its peak in the early 2000s. Um, and so I think we are starting to see a reversion to the mean where gold is becoming, a kind of regaining its kind of centrality among at least some countries' reserves. Um, and other things too, like, just basically loans to other countries that are kind of indirectly tied to hard assets, like loans to make infrastructure or commodity deposits or refining stuff. Sometimes that comes with a caveat that if those loans are defaulted on, then the rights of those assets get transferred to the lender. And so I think we're seeing a little bit more kind of hard asset commodity gold preference. The challenge, of course, is one, those types of things are less liquid. They can't be used for fast payments. And then also, the advantage of self-custody gold is that a country actually holds it, whereas a problem with those types of lending environments is if they're defaulted on, how do you enforce your property claims
Right.
in another country?
If countries are moving away from the US dollar towards gold, it means the search for hard money is on, and it's just a matter of time before they start considering Bitcoin for their reserves. But some of the crypto assets' qualities, especially the transparency of the blockchain and Bitcoin fixed supply, might not be acceptable to central banks. They undoubtedly love the lack of transparency and accountability they get with fiat currencies. Plus, it gives them the opportunity to print at will. This is why almost all of the world's central banks are researching, developing, or already utilizing central bank digital currencies, CBDC. They realize that digital currencies are the future, but they want a future only they can control. What are your thoughts on Lyn Alden's interview? Do you think the BRICS alliance and its proposed common currency are formidable opponents to the United States and the US dollar? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this.